Welcome back, everyone. Thanks for joining. Today on the Joseph Carlson Show, we're at a week where we're finally counting down to the elections. We're only days away. And this is a time every 4 years that I think is a little bit nerve-wracking. It feels like you're walking on pins and needles. I think everybody's a little bit anxious this week, just waiting to see what will happen. It's one of the rare occasions where the entire country together is just wondering what's going to happen. And most of us just want to get to the other side of this, to finally get this behind us. That's what this week feels like. Now, a lot of people mix politics and the money for a good reason. There's a lot of overlap there. But what I want to focus on in this episode is some thoughts on the elections and how we should invest around elections. For example, we have from Barron's here the election results and different scenarios that may play out depending on how the votes are counted, how long things take to drag on, and we're going to be looking at the actual historical data of what happens with the stock market after elections. We also have Tom Lee explaining the same thing, saying that even though this is a nerve-wracking time, there is reason to still be positive on the markets. So we'll be going through all of that, plus what I'm doing with my portfolio and my money regarding the elections. Now, we also have some other big news today. Palantir is reporting their earnings, and there is some high expectations for this company. This is one that has been one of the biggest winners over the past year. In fact, year to date, it's up 150%. It's a company that seemingly defies gravity. The valuation metrics on this company are pretty crazy. The assumptions going into this earnings are rather high, but Palantir has a lot of good things going for it. I'm going to be breaking down my thoughts going into this earnings in this episode. Over the weekend, we had news that Berkshire Hathaway reported their earnings. They have a record cash pile of $310 billion. That is so much money in cash. The entire market cap of Netflix, Buffett has in cash. He also continues to sell. He sold more and more Apple in this latest report. They are a seller, and they're not purchasing any shares. They're not doing any buybacks. It looks like Warren Buffett is becoming a little bearish. We'll be taking a look at Buffett's news and his bearish positioning. And then finally, as we're nearing the elections, and it's been a nerve-wracking time for everyone, I think stress levels have been rather high, it's time that we turn to TikTok to get our financial advice. I'll be reviewing one of the most cringe-inducing TikToks yet, where this mom teaches her daughter how to day trade. Now let's go ahead and jump in. We'll first jump into the headline news, which is the elections are this week, the biggest event this week. And for I think most people, many people, it's kind of the one thing that's in the back of your mind. You're just waiting to find out what happens. For many of us, we'll be staying up late, looking at the results come in state by state, having the news call one state at a time, and hopefully we get a clear winner declared on the night of the elections. But in some cases, that's not what happens. In some cases, there's no winner declared on the night of the election. So you go to bed after staying up late, not even knowing who won. And that's one of the more difficult situations. This article from Barron's reviews the data of what goes on with the markets depending on these different scenarios. Here are a few ways that things may play out. First of all, a winner could be called relatively early on election night. That is if either Trump or Kamala has a huge victory, just a blowout victory, and it's not even close. Then we have the results right away. So we can go to bed knowing who won. The other option is we could learn of a winner a few days later after vote counting has taken place in several swing states. A lot of states don't count the vote, even from mail-in ballots, until election night. Now, they have reasons for doing that. One of them is I think they don't want to bias the elections by counting them early in the week. So that could be a reason why. Another one is possibly election integrity. But either way, they don't count the vote until election night. And so that takes time. Sometimes it takes like a day to count the vote with all the mail-in ballots. So that's another scenario. It could take a few days of vote counting. Under a third scenario, a winner might be called, but the loser might contest the results, launching a process that could play out for several weeks. This third one is most likely to happen if we have a very close election. If it's just a couple states and they're very close with a few thousand votes, then they might call for a contested election. They might say that there needs to be a recount or another recount. We've seen that before with different elections. If we get the first scenario, where the election is called decisively and early, that is probably the best scenario for the stock market. Stock investors can go ahead and pop the champagne because the month after the president is elected tends to be a particularly good month to be invested in the stock market. Most analysts attribute this to a dissipation of uncertainty. Meaning right now we have a lot of uncertainty, uneasiness. Once the elections are finally done, that goes away. Investors don't like uncertainty, so that's an improvement. But then they note that there's the other scenario, 2020. The Associated Press and other news organizations didn't call the Biden-Trump match for President Joe Biden until Saturday after the election. The delay stemmed from slow vote counting processes in the battleground states, a situation that could repeat this year. I would say that that's likely to repeat. Again, unless there's one side that just has a complete blowout with voting, I think we're going to have a more slow voting process. Now, right now, most analysts are calling for a relief rally after the elections. They believe that we should be bullish going into elections because most of the data shows that after elections, the market rises. In this case, they note that most investors are pricing in if Trump wins, there'll be a bigger relief rally because he's promising corporate tax rate cuts, while Harris is promising to raise them. But either way, in either case, there should be some sort of a rally. And that's the biggest point here. The data shows that investors want overall to get the uncertainty of elections behind them. Tom Lee just hours ago noted that that is the biggest factor going into this week.
I'm bullish only in the sense that election uncertainty has caused people to de-risk and cash to sit on the sidelines, but the fundamentals have been good. Earnings season's been very good. The Fed is dovish, and I don't think it's going to matter who ends up in the White House. Even if it's split Congress or a sweep, I think markets do pretty well either way. So it sets up for a really good rally into year-end. But when it starts in November is just what we don't know.
He's correct in saying that we just went through earnings season. I reviewed all of the biggest companies, trillion-dollar market cap companies, and they show a healthy consumer. Texas Roadhouse is showing that their restaurants is full. Booking Holdings is showing that people are going on vacation. Apple's showing that people are still signing up for services and buying iPhones. Microsoft is showing that corporate companies are still buying all of their products, and so on and so forth. This is a strong stock market. Earnings looked very strong going into this election. And then you have the dovish Fed. He noted that Jerome Powell will basically do anything to make sure we don't go into a recession. He's lowering interest rates during a time where the stock market's strong, where the economy's growing, and he's still lowering interest rates. This is about as good of a situation as you can get for a stock market, except for elections. The elections are the only thing that give investors a little bit of pause. We just want to know what will happen. And so once that's over, there's likely going to be a relief rally. Now, he also notes that he doesn't know exactly when the relief rally will start. There could be some volatility ahead, especially if things get shaky, especially if it's a close election and they're counting ballots and we don't know who's going to win, and it looks like there's going to be a contested election and different things happening. That could be a little bit of volatility, but overall, in the long term, we're going to get some relief when this is finally behind us. Now, another thing I'll mention on the topic of the elections is I've been around for a while. I'm 35 years old, and this is the most important election of our lifetime. That's what you've been told many times. I'm sure you've been told that like a dozen times from celebrities, from people on Twitter, people on Threads, people on TV, explaining that this is it. This is the most important election of our lifetime. This is the one that really matters. Now, one thing that I remember is I have been told that for every single election. 2020 was the most important election of my lifetime. 2016 was the most important election of my lifetime. I was told that by everybody in 2016. I remember the same proclamations being made in 2012 and 2008 and so on and so forth. It seems like it's starting to feel like a reoccurring theme. Now, I don't want to downplay this. I do think the elections are very important. You know, they determine a lot of policy. It determines a lot of what happens in the country. But it is one thing that I've noticed, that every single election is the most important of our lifetime. And you can clip this now, you can save this in a vault for 4 years and then show it then. And I promise you, in 2028, it'll also be the most important election of our lifetime. I can guarantee you that will be said by all the same people that are saying it now. The truth is, elections are very important, and I don't want to downplay the importance of them. But after the elections, no matter who wins, life is going to go on. Things are going to continue. The US still will flourish. Warren Buffett continually talks about when he's choosing a company, you can either invest based on the company or the CEO. And if you have to choose between the horse and the jockey, he always chooses the horse. Always bet on the company. If Warren Buffett is forced to choose between a great company and a lousy CEO, or a great CEO and a lousy company, he's always going to choose the great company and the lousy CEO every single time. Because it's much easier for a lousy CEO to run a great company and for it to be successful than even a great CEO that's the smartest person in the world trying to fix a lousy company. It just doesn't work. And I believe there's a parallel here. The US is a great country. It's going to flourish. It's going to continue no matter what leadership we have. Now, of course, the optimal scenario, the one that we're looking to find, is when we have a great CEO running a great company. That's the ideal situation. But we're also okay even if we have a dummy CEO running a great company. The company will endure over time. Great companies can endure a lot of bad decisions, a lot of poor investments. Take the example of Microsoft. Microsoft had such a great core business. Their product suite of Office products were so powerful that they lived through a long tenure of Steve Ballmer throwing away money left and right, going into bad investment after bad investment. Even despite Steve Ballmer, Microsoft is now one of the biggest companies in the world. It has excelled far above other companies, even under long strings of leadership that was poor leadership. And I feel the same way about the US. I think it's the same. I think this country is too good that even if we have poor leadership, even if you don't get your candidate, I think we're going to be fine. We have too many smart people here. We have too big of a military. We're the reserve currency. We have entrepreneurship here. We have innovation here. We have capital being invested, creating new companies. We have Palantir, new company that's just going nuts. The revenue growth is insane, offering products that are incredible. We have NVIDIA. We have Tesla. We have Amazon, Microsoft, Apple, Google. We have all these companies that are just incredible, world dominant companies, all of it within the US. We have so many smart people here that we gather from around the world that it's incredible. And even though you get inundated with negative news after negative news, I can't see a world long term to bet against the US. So I still agree with Buffett. It's not time to bet against the US. No matter who becomes president, the US will continue to win overall. So I'm staying fully invested. I'm holding all of my shares. I'm currently in the process of buying stock in world-class technology companies, world dominant companies like Google. They're not going to go anywhere, no matter who wins this election. And I have a feeling over the next 5 years, I'll continue to make money in these companies like I have over the past 5. Let's go ahead and move on to some news. The biggest piece of news today is that Palantir is reporting earnings. They're actually reporting earnings today. So if we look at the assumptions here, we can see that Palantir is expected to report earnings per share of 9 cents, and they're expected to report $701 million in revenue, which is around a 26% growth rate in revenue. Now, if we look at the estimates so far, Palantir has had no problem beating their last earnings per share estimates over the past 7 or 8 quarters, but they have had a bit of a history of missing. They missed back in 2022 for 4 quarters in a row. So it's not unheard of for this company to miss earnings per share. It's happened before. But then we also have the revenue. It is far less likely that Palantir misses on their revenue. In fact, going back to 2024, they've only missed 1 time in 2022. So very, very unlikely, historically speaking, that they miss on their revenue. I would give it a very minimal chance that Palantir misses on either their earnings per share or revenue, given the history here. Maybe a 20% chance they miss on earnings per share, and I'd say a 5% chance they miss on revenue. Now, before we dive into the valuation, I first want to give a framework of the fundamentals of Palantir to show how this stock has been developing as a company. We first take a look at the top line revenue. The revenue growth shows a ton of consistency and rapid revenue growth. We have revenue growth going back over the past couple of years of around 20 to 27%. Now, that mark of growing at 20% or above top line revenue puts Palantir into an elite set of companies. There's only a few companies that can grow that fast for any amount of time. Those are companies that maintain a premium valuation. Google used to be a company that was growing at 20% for around a decade. That's how Google had those superior returns. Part of it was by their top line growth. Last quarter, we had a growth rate of 27% from Palantir. That's far in excess of even that elite category, those premium companies in the high valuation territory. They're expecting, again, 26% revenue growth. I think they're going to beat it. I think they're going to come in again at 27% or above. What makes me believe that? Well, we already saw Google's report. Google reported 35% cloud growth, which was way above Wall Street's estimates, way higher than estimates, and Google attributed that to artificial intelligence. So if artificial intelligence helped Google Cloud grow, I have to imagine that Palantir is going to be aided by the boom in AI as well. I don't think that this boom has slowed down quite yet. So I expect Palantir to have very fast growth this quarter. We can look at a KPI for Palantir. One of their biggest focuses over the past couple of years has been the growth in their US customers. Palantir started as just a contractor for the government, but now they've productized a lot of the things they're doing, and with AIP, we're seeing very fast customer growth within the US. 83% year over year last year. From a top line growth perspective, and even from an internal KPI with the number of customers, we see excellent organic growth from Palantir. That's one of the key things I look for, is a company that can grow like this without having acquisitions, without paying for the growth. Overall, the growth profile of Palantir looks great. I think they're going to beat on the top and bottom line, and I wouldn't be surprised if they continue to raise guidance. That's what I would expect. Of course, the concern is the valuation. Palantir trades at a 37 price to sales. That's on a trailing basis. On a forward basis, it's around a 34 price to sales. That is very expensive from a revenue perspective. It just means that Palantir can grow its revenue for a long period of time, and it's priced for a lot of that growth. On an earnings basis, it's also expensive. On a free cash flow basis, it's trading around 100 times free cash flow. So no matter what way you slice and dice it, again, Palantir is an expensive stock. Whether or not it can continue to exceed the expectations from investors remains to be seen, but we'll find out today. Now, over the weekend, we also had Berkshire report their earnings, and overall, it seemed to paint the picture that Warren Buffett is more defensive. He's turtling in. He doesn't seem to find a lot of value in today's market, and he continues to sell. Buffett sold off another decent chunk of Apple, cutting his stake by roughly 25% in just the past 3 months. After slashing it by almost half in the second quarter, Apple's shares gained 10% in the period ending in September 30th. Now, to put this in context, right now, Berkshire's holding of Apple's worth around $69.9 billion, so around $70 billion, versus the $174 billion at the end of last year. So just this year, he's sold well over $100 billion worth of Apple. Another important thing is Buffett hasn't really said anything negative about Apple. If you recall, going back just a couple years ago, he couldn't talk about Apple enough. He was talking about it all the time in his meetings. He called it the best company in the world. He said it was a pillar of Berkshire. Then in just the past year, he has been a little bit quiet. Didn't mention it much in his shareholder meeting, didn't talk about it much in his annual update. He really stopped mentioning Apple. So he stopped mentioning Apple, he stopped talking about the company, he sold off over $110 billion worth of Apple, and we see this stake going down and down and down for Apple. From Q4 of 2023 to Q3 of 2024, you can see his stake in Apple decline substantially every single quarter. Now, his continued selling of Apple may just be an Apple-specific thing. You can say that there's more competition, more regulatory burdens, the valuation is higher, so he has a good reason to sell Apple. And I likewise have been trimming my Apple position. So you can kind of explain that one as just a decent sell right now, but there's also more things that Buffett is doing that signal that he's in a defensive posture. For example, Bloomberg notes that he is not just a seller of Apple, he's a net seller of everything. Berkshire sold $34.6 billion in equities during the quarter and $127 billion in the beginning of the year. That's a much faster pace of disposal from last year, when he was a net seller totaling $24.2 billion over the 12 months. So in 2024, he's really selling out of his positions. Whether it's Apple or Bank of America, he's selling, he's not doing a lot of buying. In this case, the past 3 months, he has done no buying. So Buffett's selling Apple, he's selling Bank of America, he's building a cash pile of around $320 billion, and he's not even repurchasing his own shares in his company. Overall, every signal that he's sending is that he is defensive. And this is a posture that I've seen Warren Buffett do more and more as time goes on. The biggest indicator that I thought Buffett was becoming very, very defensive was in 2020. During the COVID sell-off where stocks were going down 45%, it seemed like there was blood in the streets. It was the perfect time to be a buyer. Buffett didn't buy anything. That was one of the big things that surprised me in 2020. He didn't buy any big stake in company. He didn't make any big investment during the downturn. So this is overall a continued move of Buffett being defensive, of Berkshire being a fortress. And I think it's a mistake for investors today, individual investors, trying to build up their savings for the next 30 years to take this as signal that you shouldn't be buying stock, you shouldn't be investing, you shouldn't be building portfolios and ETFs. I don't think that's a comparable situation. Warren Buffett with Berkshire is in a very unique situation. They have massive insurance companies. They have tons of investors. They have their life savings in that company. So he has extra reason to be extra conservative, more than the average investor. Now, moving on, we have to review this TikTok. This one is, I'm teaching my 12-year-old daughter day trading, and she's doing so well. Let's go ahead and take a look here.
We're just sitting in our new backyard, and Addie is looking at her trade.
Okay. Right off the bat, she says, we're sitting in our new backyard, which it looks like they're at a nice resort with the scenery. This is the template. This is what they do every time. When you are a day trader, you need to give yourself some validity. You need to show that you're successful. There's no better way to do that than to set the setting. The setting needs to be that you're either sitting by an expensive car, you're standing by your Corvette or Lamborghini or something, you're standing in front of a big house that has a bunch of garages, or you're sitting in your nice backyard, showing that you own this property, it's nicely maintained, you have wealth. That is how they always start these videos. But let's continue on here.
Backyard, and Addie is looking at her trades. Boom, baby. So she's been able to set those trades in under 10 minutes a day. And while she's at school, those trades are just making profit for her, and it's all passive.
It's just that simple. 10 minutes a day, set the trades, go to school, and it's just making her money passively. It's basically free money. This is all you have to do in life. I don't know why you're all going to your day jobs, slaving away at your 9 to 5s, when you can instead just download this app, set a few trades, 10 minutes a day, make money while you're out and about. It's really just that simple.
Oh, dang. That's a good one. What's the risk to reward on this one?
Oh, do I need to put it higher?
No, you're good.
Oh.
Wow, 1 to 3 risk to reward.
So you're basically guaranteed to win. Now look, I understand wanting to include your children in things, wanting to include them in wealth creation and learning how to make money, and all of that's great, but teaching them how to day trade, advertising it as 10 minutes a day, make passive money, 1 to 3 risk reward, this is all salesy stuff that every day trading channel does. If you look at the data, it is overwhelmingly negative. Every single study and piece of data shows that this is not the way to generate long-term wealth. So hopefully they can change it around. Hopefully she can learn, instead of day trading and pretending that it takes 10 minutes a day and you can make easy money doing that, hopefully one day she instead learns what real investing is. That's all for this time. See you in the next one.